Welcome to the Plan B CRNA podcast. I'm your host, Bobby Jones, and I wanted to let you know that I'm changing things up a bit this summer. One of the benefits of passive income is being able to buy your time back. And that means for me, it's time for a vacation. It's pretty tough to do interviews though when I'm out of town. So in lieu of guests, I've decided to provide some education about real estate and apartment investing since this has been the key to my own financial freedom. I'll cover various topics that are integral to your own understanding for the entire month of July. Don't worry though, I'll be back with more Provider Spotlight interviews in August. In the meantime, I hope you enjoy your summer and these episodes. Now, on with the show. Hi, this is Bobby Jones with On Call Capital. Many real estate investors make their purchases using money that they happen to have on hand. But did you know that you can use your retirement funds instead? Yes, you can use your retirement funds by placing them in a self-directed retirement account. You can keep the benefits of a retirement account while investing in steady recession-resilient real estate. So what is a self-directed retirement fund? Basically, it's one that allows you to also invest outside of the traditional stock market. You can invest in things like single-family homes, apartment syndications, self-storage funds, business startups, ATM funds, and the like. A common misconception comes from those who have solo 401ks and SEP IRAs. Many of those folks think that a solo 401k or SEP IRA is a type of self-directed account, but the account type isn't what makes it self-directed. It's all about the custodian. If you have accounts with a traditional brokerage such as Charles Schwab, E-Trade, or TD Ameritrade, then those are not self-directed. Those types of custodians only allow you to invest in the traditional stock market and its derivatives such as options. In order to have self-directed funds, you need to find a custodian that allows you to invest outside of the stock market. This includes custodians such as Midland Trust, UDirect IRA Services, or Gold Star Trust. If you currently have certain retirement accounts such as IRAs, 401ks, education savings, and healthcare savings accounts, you can convert those over to self-directed retirement accounts by contacting a self-directed custodian. Once you are set up, you can send funds from your traditional brokerage accounts over to your self-directed accounts. Since these types of funds can take a bit of time to set up and get funded, you should do this before you have an actual investment in mind. Otherwise, you could risk missing funding deadlines. I'd like to focus on a little-known retirement account called an Enhanced Qualified Retirement Plan, also known as an EQRP. I will start off by saying that this account is not for everyone. To qualify, you must have a qualifying business. Any business venture from an online business like an Amazon store to, dare I say, an anesthesia LLC can qualify. Many legal structures work as well, from a sole proprietorship to corporation, partnership, LLC, LLP, and not-for-profit 501c3 are eligible. So what are the benefits? You essentially have checkbook control of your retirement accounts. If you want to invest in something, you simply write a check. No waiting on a custodian to give you permission. Real estate, business startups, and alternative investments are all on the table. Even if you need to borrow money, you can write yourself a check for up to 50% of your assets or $50,000, whichever is higher. You can also defer up to $57,000 in income from taxes every year if you're under the age of 50. You can buy real estate and use debt as leverage with absolutely no taxes. That's right, no UBIT to worry about like in other self-directed accounts. There are also no minimum income requirements for an EQRP. Income from your business that acts as a plan sponsor is income that you ultimately use to determine eligible contributions. Pretty cool stuff so far, right? There is one important point to consider, of course. While you can roll over your 401k, traditional IRA, self-directed IRA, 403b, 457, TSP, and solo 401k into an EQRP account, you cannot roll over a Roth IRA. Otherwise, this is definitely an option for many CRNAs and healthcare professionals who work 1099 with their own business entities. For more information, I would encourage you to check out Damian Lupo. He is the EQRP expert, and he has a free ebook available on his website, www.eqrp.co. I hope you've enjoyed learning about this obscure type of retirement account. As a follow-up to my video on self-directed retirement accounts, I wanted to touch on one of the caveats to investing with a self-directed IRA. Generally speaking, having a self-directed account is highly favorable for investors because you can invest in real estate as opposed to just investing in the stock market. Thus, your account can steadily grow in size as you receive distributions and your real estate appreciates. One of the most important things you must consider, though, is the unrelated business income tax, or UBIT. This is also known more specifically as the unrelated debt financed income tax, or UDFI tax, but it is more commonly referred to as UBIT, so I'll use this term instead. Yes, you have many tax advantages in a self-directed account, but the UBIT is a tax on the percentage of an opportunity's gains that are attributed to debt financing. Since real estate is regularly purchased using debt leveraging, it is expected that UBIT will come into play with most self-directed real estate investments. It is common for real estate investments to be acquired with 70% debt financing. Does this mean that 70% of your gains will be taxed? Well, the simple answer is, well, let me just first start off by saying that I'm not a tax expert and that none of this is meant to actually be tax advice. But the benefit of using debt financing within a self-directed account is that you are now able to use the depreciation expense associated with the property. This is not allowed with other investments in a self-directed account, so that distinction is important. This depreciation serves as a counterbalance to the UBIT. Usually this results in no taxable income during the hold period of a property, with UBIT only coming due upon sale when gains are realized. Now, I don't want to get into the nitty-gritty of the numbers here because it would likely be way too confusing for our purposes. The long and short of it is that there is a tiered tax rate system used to calculate UBIT, depending on how much unrelated business taxable income that you have. Because it is tiered and you are only being taxed on 70% of the gains from sale, the amount of taxes ends up being much less impactful. When running the numbers, you are likely only to lose 1 to 2% in IRR for your investment. The main point is that even after UBIT, you are still looking at potentially excellent returns from real estate within a self-directed account. UBIT should not deter you from utilizing your self-directed accounts to invest in most apartment offerings. Heck, that's how I've invested in a couple of deals, and I plan to do it again. Run the numbers with your CPA and then invest away, my friends. That's it for this one. If you enjoyed this video, I hope you'll stick around by clicking subscribe. Also, feel free to visit my website at www.oncallinvestments.com for more information about apartment investing. That's going to do it for the show. Thanks for listening to this episode of the Plan B CRNA podcast. If you enjoyed today's show, make sure you hit subscribe and give us a 5-star review. This show only grows because of you, so make sure you share it with a friend, family member, or colleague to help them on their own passive income journey. And if you'd like to know more about me and gain access to passive investment opportunities, make sure you find me on Facebook, LinkedIn, or visit my website at www.oncallinvestments.com. This is Bobby Jones signing off. Until next time, be safe and take care of each other out there.